I think the first thing that is important is to understand why you would be looking for amortization in the first place. Most of the time in commercial real estate, you tend to not have fully liquidating loans, right? In residential mortgages, most of the time people get 30-year fully amortizing mortgages. So by the time they get to the end of the 30 years, the mortgage, the principal, and the interest are all repaid. In commercial real estate, it's much more common to have balloon balances when you get to the end of your mortgage term. So as a lender, one of the things, a lot of times in the debt space, you'll hear the expression loan to own. And there's a misunderstanding that a lot of times lenders will make loans on commercial properties with the ultimate indifference to whether or not they get repaid or whether or not they have to take back the property. The reality is that when you're a lender, you really don't want to ultimately have to take back a property because it means that you have to own and operate that property. And to the extent that you're taking it back, it probably means that there's some level of stress, either market stress or stress at that particular property. Most lenders really want to make their loan, they want to collect their interest, and they want to get their balloon balance repaid at maturity so that they can go on and to make a new loan. They really don't want to have to take over a property and own that property. So when you're structuring a loan at the outset and you're thinking about things to mitigate risk, one of the tools that you have to use is amortization. Why is amortization a risk mitigant for a lender? It's a risk mitigant because what it does is it deleverages the loan over the term of the loan. So in other words, if you have an amortizing loan, your beginning loan to value, when that loan is first issued, is going to be higher than your ending LTV, your ending loan to value ratio, which means that at the end of that loan, when it comes time for that loan to be refinanced and for you to get paid back, there's a lower dollar amount that needs to be procured when that new loan is obtained. So, when you're thinking about amortization, you're kind of thinking about it in the context of deleveraging or reducing your risk. So what types of things would go into determining which particular amortization schedule you would choose? The first thing is the leverage that you're lending. What is your going in loan to value? And what do you hope to have as an ending loan to value on your way out? The more you want to deleverage that loan, the shorter the amortization schedule you want to impose on that borrower. One of the other things you want to think about is property type. Certain property types are considered more volatile, more risky. At one end of the spectrum, you have properties like multifamily, which are considered fairly liquid. They're considered fairly stable. They're one of the lower risk types of properties. And then at the opposite end of the spectrum, you have properties that also encompass some sort of an operating business component, like a hotel property. So the riskier the asset class, the more amortization you may want to impose because, again, you want to go into your refinancing scenario with as little risk as you possibly can. But there's a flip side to that story too. Generally speaking, people think more amortization is better, but the shorter your amortization schedule is, it means the more principal pay down you're going to require of that particular borrower. And that means that the monthly debt service payment that the borrower is going to have to pay is going to be higher. And there's always this balance. You always have to balance the benefit that you're going to get from additional principal pay down with what stress or what strain, what additional strain you're placing on the property and placing on the borrower by demanding a higher monthly payment from them. So, there's the give and take, right? Ideally, you might like to have a very short AM schedule, but you may decide that you want to go with a longer AM schedule so that the monthly payment is shorter and it is lower, excuse me, and you put less stress on that borrower and you don't kind of force them into a default during the term of your loan.